Hi everyone, happy new year and welcome back. Today I've got Nick joining me again from Evidentia, and Evidentia form part of our investment committee. And today we're just going to have a bit of a deeper dive into what's happening with markets at the moment. Obviously the pandemic is still bubbling away, but there's a few things in the background. So there's some geopolitical tension at the moment between Russia and the Ukraine, and then also on top of that, we've got inflation, interest rate hikes. So there's a few things happening at the moment, and markets have been a bit unstable. They touched all-time highs, I think, at the start of January. So things were looking pretty good up until then, and have recently pulled back. So, Nick, do you want to give our clients just a bit of an update on what's been happening over the last couple of weeks?
Yeah, sure. And Happy New Year, everyone. And thank you, Angus, and the team at Prime for having me back. And yeah, and as you said, Angus, so there's been a few wobbles to the year. Safe to say that we've had a bad start within equity markets for 2022. And as you say, there's quite a few things going on that are contributing to shares kind of trying to climb this wall of worry. First of all, there's the Omicron variant of COVID, which we've seen has been much more transmissible. We've seen that have potentially impacted supply chains and a flow-on through effect to inflation. A notable example of that would be China. Their focus on a COVID zero policy. Again, with Omicron flaring that up, that can have some impact to supply chains and inflation in the shorter term. But what has really started to rattle the markets has been really from the middle of November last year. The rhetoric coming out of the US Federal Reserve has turned a little bit more hawkish. So first of all, there was kind of the acceptance or acknowledgement of inflation looking more persistent than transitory in a few aspects. And then more recently, as we've seen, inflation hit about 7% in the US, and it is now the highest there it has been in 40 years. The market has really started to recalibrate their expectations around inflation and central bank policy setting. And to expand on that, we've seen the US Federal Reserve come out in their first meeting of this year and basically stated that rates are likely to rise or lift off in March this year, as well as an end to their bond buying program, which we call quantitative easing. And more locally at home, we've seen the RBA now move to, or the market here at least, price in expectations for slightly over 25 basis point rate hikes this year. And that's now because we've seen inflation come out higher than expected. So we had a recent inflation reading showing inflation for the year last year locally in Australia is about 3.5%. So the market is now starting to expect that the interest rate, or pricing in that the RBA will raise rates from about the middle of this year. And as you said, Angus, there's some geopolitical stuff as well that we can't dismiss. And it's kind of a secondary impact to what's happening with central bank policy, but also a very important one. We've seen about 100,000 troops being amassed on the border of Ukraine. And a lot of that's around the kind of ambitions for the West and NATO to expand NATO to Ukraine and Georgia. And Russia's in a really difficult position there, that they would have to really kind of see some resolution to save face. They've got aspirations to kind of win back territory from the old Soviet days, and also regain power as a global superpower, given, the US in many ways looks like they're a declining global superpower. And also importantly, Biden has stated, like many of his predecessors, that the focus should be on China and the Indo-Pacific, and really Washington, Congress and the government can only really deal with one major policy at a time. So that's just another thing to watch as the year unfolds, what happens in geopolitics as well, Angus.
Yeah, and it's a good point, Nick. I think, if you look back at any point in time in history, there's always these events happening, which, if they're bubbling away behind, they're affecting markets in some way.
Yes.
But if we look at some of the fundamentals, like unemployment rates are at record lows, growth rates are at record highs, company profits are also really, really strong at the moment, underpinning this growth market. So if you have a look at the noise and the events versus the underlying figures and the data, what do we expect? How does this then play out moving forward in 2022, you reckon?
Yeah, and that's a really good point, Angus, to reiterate with all listeners today, is that shares do climb a wall of worry over time, and there's always a number of macro, geopolitical, or market headwinds that the market grapples with that cause these intermittent kind of risk flares in markets that don't offset a broader rising trend in equities over the longer term. And as you say, Angus, I mean, data is quite impressive in many regards. If we look at the US, for example, US growth has hit close to record highs. So they've recorded their strongest economic growth, or their GDP, through 2021, the highest since 1984. So GDP in the States last year was 5.5%. Now, the unemployment rate has gone down to 3.9%, and US output, or GDP, is about 3% above its pre-COVID levels. So growth is certainly strong. You've seen the consumer spending increase last year in the US by close to 8%, and that's the most since around about 1950, or even a little bit before then. And in addition to that, as you said, Angus, earnings have surprised on the upside, particularly in some of these sectors where the market is quite concerned about, which is tech, or most notably technology. We saw Apple have a very good fourth quarter result, and that really underpins the statement that a number of these profitable tech companies, and particularly the FANGs that have had business models that have allowed them to have strong performance, have not disappeared. So there's certainly some, buy the opportunities in companies potentially like Microsoft. But really where you want to keep an eye on is some of these non-profitable technology companies. That can be names like Uber, Peloton. And if you look at, there's an index, a Goldman Sachs index of unprofitable tech companies. If you look at how that's gone from mid-November last year up until recently, I think it's down about 40% versus the Nasdaq's decline of 15%. So again, it's just focusing on quality companies, profitable ones. I think now leaning into value and more cyclical parts of the market, which tend to be well bid and outperform in an inflationary environment, is quite sound. But as you say, global growth is strong. Domestically, growth is strong. Unemployment in Australia is also now about 4%, which is healthy, and our wages growth will get to the point where the RBA is likely to raise rates this year.
Yeah. And so I guess for our clients, they should be aware that we've already started to position our portfolios for this inflationary trade and increasing interest rate environment, which can be tricky to navigate. And obviously it's causing volatility at the moment. But maybe just very, very shortly, Nick, or very quickly, can you summarize some of the positions that we've got across the portfolio, broadly speaking? So, lower duration on the bonds and some others.
Yeah, look, so the most notable one in the fixed income side. So we've seen a recalibration of inflation expectations and interest rate expectations affect both shares and bonds. And the reason that interest rates are so important are that shares are valued off earnings and interest rates, and bonds have an inverse relationship between interest rates and price. So last year we saw traditional bonds in Australia, or the composite bond index, was down about 3%, or about 2.79%. It also had two of its worst months in its kind of 30-year plus record, in February and October being down about 4%. Now, the way that we've set up portfolios and managed risk and construct portfolios at Prime, as part of the investment committee, has been to be a lot more resilient than the broader bond market. And as you alluded to, Angus, that's been to be short duration, which means that we've removed or had a lot less exposure to rising interest rates than the broader market, which has seen us fare very well versus the broader market in bonds. And that's by doing things like moving into floating rate, credit funds with a low duration, absolute return managers, and allocating to managers that can employ a kind of relative value trading approach to exploit market anomalies without having exposure to those fixed rate coupons, which see you have losses in those bonds as interest rates rise. And on the equity side, we have been maintaining some exposure to emerging markets despite some of the headwinds last year, again in anticipation of some more recovery themes benefiting what's a more cyclical or high beta region in emerging markets. And certainly we know that with improved trade balances and rising commodity prices at emerging markets, and you can see that this year are starting to hold up in select countries particularly well. And then finally, Angus, again, as I alluded to before, leaning into value companies, again, those cyclical businesses with mature profits that tend to outperform in an environment where inflation and interest rates start to rise.
Great. All right, thanks, Nick. We'll leave it there for today. With this video, there's going to be a link under the video just to follow a more, just an expanded version of this market update. So feel free to read that. But of course, in times like this, it is important to stick with your investment strategy. And if you still feel a little bit unsure with what that is and how you might impact your situation, of course, pick up the phone, speak to your advisor. They'll be more than happy to field any questions that you may have. So thank you again, Nick. Thanks for joining us, and we'll chat again shortly.
Very welcome. All the best.
Cheers.